Hello and thank you for joining me for the next Bell Direct reporting season video this August reporting season 2025. I'm Grady Wolf, Senior Market Analyst with Bell Direct. So far this reporting season, as we hit the heart of the earnings period, 74 companies have reported, with 16 beating expectations, 33 meeting expectations and 25 missing expectations. The further we progress into the reporting season, the more we are seeing the gap between beats and misses expand in favour of the misses, indicating a broad weakness in results across the board in FY25, attributable to tough operating conditions faced during the last financial year. In total, 16 companies have been upgraded by brokers, while 13 have been downgraded. Let's dive into some of the key results we've seen this week so far and any new learnings for FY26. The world's largest miner, BHP Group, ASX BHP, released softer than expected results attributed to weaker iron ore demand out of the world's second largest economy, China. BHP reported a 26% drop in underlying net profit to $10.2 billion or $2 per share, its weakest profit since 2020, driven by lower iron ore prices that more than offset stronger copper volumes. Revenue fell 8% to $51.3 billion, while EBITDA declined 10% to $26 billion. The final dividend of 60 US cents per share brought the full year payout to $1.10 per share, down from the prior year but ahead of analyst expectations. Despite the earnings decline, shares rose modestly yesterday, ending Tuesday's session up 0.68%, likely due to improved cost guidance and a more disciplined capex outlook. Copper stood out as a key bright spot for BHP, contributing 45% of EBITDA as production hit a record 2 million tonnes with bullish long-term demand projections. Meanwhile, iron ore remains BHP's largest earner despite weaker prices and a 24% fall in EBITDA. Coal earnings slumped 75% amid weaker pricing and higher costs, prompting potential closures in Queensland. BHP also flagged a possible sale of its struggling Nickel West assets. While the near-term outlook is supported by resilient commodity demand from China and India, many analysts hold a cautious long-term view on BHP and commodities in general, expecting structurally lower iron ore and copper prices beyond 2029. Healthcare and market heavyweight CSL reported a 5% rise in revenue to $15.6 billion and a 17% lift in net profit to $3 billion, with steady growth from Vifor, the company's iron deficiency anemia therapies division. Underlying profit and NPATA rose 14% and the final dividend increased 12% to $1.62 per share. Despite these results, CSL plunged 17% in their worst day since listing after guidance for FY26 missed expectations, and the company announced a major restructure, including the demerger of Seqirus, the vaccines unit of the company, and a 3,000 job cuts. The planned spin-off, aimed at unlocking value and streamlining operations, has been met with investor skepticism, particularly given Seqirus's underperformance and weak vaccine sentiment in the US. While CSL is targeting over $500 million in annual cost savings by FY28 and launching a $750 million share buyback, concerns remain over slowing earnings momentum at Behring, the company's largest division. The market is cautious on whether the restructure can reignite growth and justify CSL's premium valuation. And global building materials company and fibre cement producer and manufacturer Hardie Industries, ASX JHX, tumbled over 20% after releasing FY25 results that both missed expectations and signals further weakness to come. Hardie Industries reported a tough start to FY26, with Q1 net income plunging 60% to $62.6 million and sales down 9% to $900 million, missing consensus estimates. North America, Hardie's largest market, saw a 12% decline in sales due to persistent weakness in single-family construction, affordability challenges, and continued inventory destocking. Adjusted EBITDA fell 21% to $226 million with margins compressed by inflationary pressures, particularly pulp costs and lower volumes. Management downgraded full-year expectations, now projecting a high single-digit decline in market demand and cutting free cash flow guidance from at least $500 million to $200 million. The company is pinning longer-term growth hopes on the recently completed acquisition of AZEK, which more than doubled its addressable market and already exceeding expectations. Over half of planned cost synergies have been actioned, with $125 million targeted over 3 years. Despite strategic optimism and ongoing investments in innovation and operational efficiencies, investors reacted sharply to the soft guidance and murky near-term outlook. Shares in James Hardie fell nearly 30% to a 3-year low as concerns around housing market weakness and delayed commercial benefits weighed heavily on sentiment. So while these three companies each missed expectations, it goes to show just how important outlook is at determining investor reactions this reporting season, with BHP's outlook sparking a share rally, while ongoing weakness resulted in investors fleeing CSL and JHX or James Hardie this week. Further themes emerging this reporting season to consider when making investment decisions for FY26 include cost management and margin pressures eating into profits. Be cautious of how companies handle costs and the outlook for cost reductions. Weakness in key regions or divisions of operating will cloud any outperformance of guidance of smaller divisions. And diversified earnings is the key to stability in FY26. And that's all for this Wednesday, the 20th of August. Stay tuned for our 6th reporting season video this Friday, covering more big names set to release results over the coming days.